What a reaction to Fed Chair Powell. You think it was the fact that he ruled out that 75 basis point hike and confirmed market expectations?
I think that's a part of it, Sarah, but I think it's just we now know what we're dealing with over the summer. We've got 250s pretty much locked in. We know what an aggressive policy response to this inflation outcome looks like. And a lot of us didn't know exactly what that was. The committee had to debate that. They debated it. They came up with a unanimous decision. I think that's important. There's not a lot of dissents. They're going to go pretty strong, but the market was pricing in the risk of something stronger. And, you know, Sarah, just not to get too ahead of ourselves, this is exactly where we were Thursday, Friday last week in terms of S&Ps, the dollar, and a lot of other indices that we would look at for financial conditions. So I think the market just saw the beginning of this week and got a little bit nervous that it could get more aggressive, especially after last FOMC meeting when they delivered a very hawkish S&P relative to market expectations. So I just think it's a standard relief rally to a Fed that is not as panicky as some might have feared. And I think that's important.
Well, also big reaction in bonds. Yields came below that 3% on the 10-year yield, a big bounce there. Bull steepening in the yield curve. The dollar's weakening. Even the Japanese yen is strengthening. Powell basically did it all. Investment implications, though, beyond this just reaction in the near term.
I mean, we're going to get hit pretty hard with monetary accommodation removal. The risk was we were going to get hit harder. So it was just a question of how hard he was going to punch. And the punch wasn't as severe as feared. That doesn't mean that he can't up the ante as we go through the summer and the inflation data don't cooperate. We all will be waiting to see that. I think the other thing about his press conference that was important, Sarah, is he is so focused on the inflation. He's not talking about any serious cracks in growth or the labor market or the housing market. So you really, really need to see this inflation come down in a relatively, I don't want to say aggressive, but in a calculated and continuous way. Otherwise, he's going to have to change course a little bit. So it's a reprieve. There's no question we get a little bit of a springtime reprieve from a less than aggressive Jay than we had feared. But generally speaking, I think we should all be on the lookout for something that's more aggressive in the future, not an immediate pullback and say, oh, all is clear. We nailed this. It's good, even if the inflation data come out okay over the next 2 or 3 years.
Also, to your point, and the fact that he was so serious, you know, speaking to the American public about inflation and the duties that they have, I do wonder if if there is a policy mistake, it's more in the camp of recession than in letting inflation stay too high for too long, and they're willing to tolerate that. So, David, that seems to me to be a big risk for stocks beyond today and maybe the near term.
Yeah, I'm with you, Sarah. I think they're going to err on the side of really pushing inflation back into a hole. Even if we get good numbers, I think they're going to still remain cautious. There was a point in the conference the press conference where someone asked him about fiscal policy, and he made an off-the-cuff remark about how, let me just figure out my job, which is getting inflation down here, and then I'll be able to give some advice on fiscal policy. I think there's a bit of, there's a bit of self-deprecation going on, a bit of, soul searching going on that just says, hey, we got to get this done. They're hoping that this is enough. The market priced in a little bit more. They gave them a little bit less. It feels good today. We're only back to where we were last week, which is still down 10% on the year. I wouldn't get too overly excited about some runaway in risk assets.